Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. A tech bloodbath rocks Wall Street as the Nasdaq plunges nearly 1.9%. Alarm bells ring as $820 billion in AI market cap evaporates, triggering a frantic rotation out of tech. Second, Trump's landmark deal ignites pharma war. Eli Lilly and Novo Nordisk / obesity drug prices, unlocking 40 million new patients. This isn't just about healthcare. It's a seismic economic event. Will this trigger a global arms race, and what does it mean for the future of inflation? Finally, Nvidia's reign under siege. Google unleashes its secret weapon as AI giant Anthropic makes $1 billion bet, rocking the chip market. This is a declaration of war in the AI hardware race. Is Nvidia's monopoly crumbling, and who will win this high-stakes power play? Warning, today's market turmoil is a danger signal. Holders of high-valuation tech act now. The Nasdaq has taken a heavy hit, dropping nearly 1.9%, its worst weekly performance since March. And I'm telling you, this is an escape signal. Shift your focus and reposition your portfolio immediately. The tech-heavy Nasdaq closed between 22,650 and 23,000, down significantly as investor sentiment shifted from AI euphoria to valuation concerns. Meanwhile, the S&P 500 fell 0.74% to 6,720.32 points. This isn't just a dip. It's a decisive rotation away from high-risk tech to value-oriented stocks, driven by a surge in institutional selling. Trading volume hit 3.2 billion shares, a clear sign that big money is getting out. This isn't passive rebalancing, it's a retreat. Listen closely. The labour market is deteriorating. October saw 153,000 job cuts, the highest in over 2 decades, concentrated in tech and AI sectors. ADP's report was dismal, with only 42,000 new private sector jobs. With consumer sentiment at a 41-month low, we're teetering on the edge of recessionary conditions. The Fed's rate cut expectations are collapsing, dropping from over 90% to around 63.8% for December. This shift jacks up the discount rate, squeezing tech stock valuations further. The Nasdaq's tech giants are overvalued, and without immediate catalysts for growth, the downside risk is real. Let's break it down. The Fed's policy shift is pivotal. Jerome Powell's recent remarks suggest a pause in rate cuts, throwing cold water on the market's soft landing hopes. The Fed's reluctance to cut rates further raises the cost of capital, pressurizing long-duration assets like tech stocks. The CME FedWatch Tool's rate cut probability drop is a stark warning. Rate hikes are effectively back on the table, compressing equity valuations. Capital is fleeing tech, flowing into defensive sectors. ETFs tracking the Nasdaq are seeing outflows, while defensive sectors like utilities, XLU, and consumer staples, XLP, are gaining traction. The VIX, the market's fear gauge, has risen to 20.70, signaling increased volatility and risk aversion. This isn't just a tech pullback, it's a broad-based risk reassessment. Valuation is another critical layer. The tech sector is facing a bubble reckoning. Nvidia and Palantir are prime examples. Nvidia's stock is down over 8% this week, losing $450 billion in market cap, driven by geopolitical risks and unsustainable PE ratios. Meanwhile, Palantir's 6.8% drop despite strong earnings highlights the market's skittishness over sky-high valuations. The AI sector's $820 billion market cap loss this week signals a fundamental reassessment of growth prospects. Here's your playbook. Good advice makes you rich. Bad advice costs you a fortune. Listen to me. Cut tech stocks immediately and rotate into financials and value plays. Short-term 1 to 2 weeks. Reduce tech exposure by 15 to 25%, especially in Nvidia and Microsoft, and shift into financials, XLF, and utilities, XLU, by 3 to 5%. Watch for the Nasdaq to test the 600 support level, medium term, 1 to 3 months. Rebalance by increasing allocation to consumer staples, XLP, and healthcare, XLV, by 2 to 3%. Defensive, 3+ months. Maintain a 15 to 20% cash position for strategic redeployment when markets stabilise. Sector focus is essential today. The tech sector is bleeding, with Nvidia, Microsoft, and Meta facing sharp declines. Nvidia's 3.7% slump today alone is staggering. Meanwhile, the materials sector is a standout, buoyed by gold's rise above $4,000 per ounce. Gold miners are the winners here, reflecting a flight to safety. Energy stocks, though pressured by oil prices, show resilience with steady dividends. Utilities are the stable choice, offering protective dividends and lower volatility. Act now. Don't wait for the market to dictate your moves. If QQQ breaks 420, that's your escape signal. Hedge positions using SQQQ or put options for downside protection. Advanced investors can employ options spreads, while intermediate investors might use inverse ETFs. For the conservative, cash is king, maintain liquidity to pounce on opportunities. Time's ticking. Let's dive deep into today's critical market dynamics and prepare for what's next. Follow this framework and you won't lose. Now let's examine today's key news stories. The story today begins with a landmark deal brokered by former President Donald Trump with drug giants Eli Lilly and Novo Nordisk, which could suddenly give 40 million new patients access to blockbuster obesity drugs. These are the GLP-1 treatments like Wegovy and Zepbound, which carry staggering list prices of $1,000 a month or more, blocking out millions. But under these new agreements, that reality is being completely upended. For certain Medicare patients, the cost will plummet. The price Medicare pays will be slashed to just $245 a month, with patients responsible for a copay of only $50. This is a massive shift. A law currently prohibits Medicare from covering these drugs for weight loss, but the government is launching a pilot program in 2026 under a temporary legal mechanism to bypass it. But that's not the whole picture. This level of access comes with a hefty price tag. You see, while it's a huge win for patients, it creates a significant fiscal challenge for the government. The Congressional Budget Office, or CBO, projects that this expansion will increase federal spending by a staggering $35.5 billion over the next 9 years. This pits a major public health advance against the need for fiscal responsibility, creating a key political and economic battleground for years to come. The potential is enormous. According to a JP Morgan analyst, the new eligibility criteria mean 80% of the obese population in Medicare could suddenly gain coverage. And this massive expansion in the US market is sending shockwaves globally, kicking off what some are calling a new arms race in pharmaceuticals. After all, the sheer size of the US demand, now backed by government policy, solidifies its role as the key driver of the entire global market. This puts immense pressure on European and even Chinese drug makers to accelerate their own development of similar drugs and potentially seek similar state-backed pricing deals just to compete. For China's pharmaceutical industry, this means they must innovate faster and navigate complex global supply chains to secure a piece of this rapidly growing market. And the shockwaves don't stop there. One health policy expert predicts private insurers will quickly follow Medicare's lead, creating immense pressure to expand commercial coverage across the board. And that prediction is grounded in a solid precedent. Medicare's coverage decisions have historically served as a powerful benchmark for private payers. When Medicare makes a major move like this, private insurance companies often have to adjust their own policies to stay competitive and manage public perception. This could quickly shift these drugs from a luxury good to a standard benefit for millions more. For those paying cash, the deals offer deep discounts on a direct-to-consumer website, trumprx.gov, with some monthly costs for injectable drugs dropping to $250. Future pills are expected to start at just $149 a month. Now, here's where it gets interesting for the broader economy. Cheaper drugs mean more money in people's pockets, and the situation presents a fascinating duality when it comes to inflation. On one side, the lower drug prices will directly push down the healthcare component of the consumer price index, which is a disinflationary good news story. On the other, with households having more disposable income, they might spend more on other things like retail goods or dining out. This increased demand could create an inflationary impulse elsewhere in the economy. It's a complex dynamic for the Fed to navigate. Eli Lilly's CEO notes that the US currently has about 9 million people using these drugs. This deal could add 40 million more eligible patients through Medicare alone. It's not just a policy change. It's a seismic event set to completely reshape the multi-billion-dollar weight loss market. And the ripple effects could go far beyond just the drug market, with profound implications for the entire economy. It all comes down to the link between public health and economic productivity. Studies show that obesity contributes to significant productivity losses through increased employee absenteeism. By making these treatments widely accessible, we could see a healthier workforce, which means fewer sick days and higher productivity. Over the long term, this could act as a positive supply-side shock to the economy, boosting GDP growth and potentially helping to offset the high initial cost of the drugs themselves. The focal point to watch will be labour market indicators like absenteeism rates and productivity metrics in the coming years. Speaking of seismic economic events, let's pivot from healthcare to the high-stakes world of artificial intelligence, where another multi-billion-dollar power play is unfolding. A major AI startup just made a bet worth tens of billions of dollars, and it's sending shockwaves through the tech world. The company is Anthropic, and they're planning to use up to 1 million AI chips to power their Claude model. And get this, they're not just betting on the market leader Nvidia, they're going all in on Google. A while back, we broke down how the chip war shifted when OpenAI moved to adopt AMD's next-gen Instinct GPUs, along with the possibility of taking a stake in AMD, and when Oracle rolled out 50,000 Instinct chips in its cloud. That was the first clear crack in Nvidia's near monopoly. Today's Anthropic move extends that playbook, but with a twist. The second source isn't just another GPU vendor, it's a second architecture, Google's TPUs. This is where the situation takes a more complex turn. The move signals the rise of a multi-chip strategy, which is rapidly becoming the new industry standard for top AI labs. So the thing is, companies like Anthropic don't want to be locked into a single supplier. By using a mix of chips like Google's TPUs, Amazon's Trainium, and Nvidia's GPUs, they gain huge negotiating leverage. This forces all chip designers to compete fiercely on performance, power efficiency, and software, preventing any one company from having a monopoly. As we discussed with AMD's resurgence, once a true second source appears, price and design competition accelerates. Today's update raises the stakes by pitting GPUs against a mature alternative in TPUs. For years, Google has been one of Nvidia's biggest customers. But while the world watched Google buy chips, it was also building its own secret weapon. After a decade of development, Google is unleashing its 7th generation custom chip, a powerhouse called Ironwood. The company claims it's more than 4 times faster than its predecessor, designed to handle the heaviest AI workloads. And crucially, Google is making Ironwood broadly available through its cloud, not just keeping it internal. However, if you zoom out, you'll see another layer of strategy at play, rooted in the difference between Google's custom chips and the GPUs most of the world buys from Nvidia. Nvidia makes GPUs or graphics processing units, which are like a powerful all-purpose Swiss Army knife. They're great for many things. Google, on the other hand, builds what are called TPUs, or tensor processing units. Think of these as highly specialized tools, custom made for one job and one job only, running AI calculations at lightning speed and with maximum efficiency. This is a structural shift in the AI hardware market. The accelerating adoption of these in-house custom chips represents a move away from general-purpose merchant silicon toward proprietary solutions. We previously analysed how top labs taking stakes in suppliers could influence future chip design. Google's decade-long TPU bet shows another path co-designing around a proprietary accelerator available at massive scale. This trend could ultimately limit the long-term pricing power of market leaders like Nvidia. This isn't a side project. It's a direct challenge. While Amazon and Microsoft are years behind in developing their own custom silicon, one analyst says Google is the only one that has deployed these chips in huge volumes. Believe it or not, this is creating a powerful competitive advantage, or a moat, for Google's cloud business. The main battleground among cloud providers is no longer just about storage or basic computing. It's about who can offer the most efficient AI training. With its decade-long head start on TPUs, Google is winning big, with its cloud revenue for AI-related services growing significantly faster than its rivals. And unlike the AMD OpenAI play we covered a while back, which secured a second source of GPUs, this move gives Anthropic access to an entirely different compute stack, deepening its bargaining power across architectures. The company is now backing this strategy with a staggering capital expenditure forecast of up to $93 billion for the year. So why such a massive number? Because it's not just about buying chips. A huge portion of that budget is going toward the physical constraints of AI expansion, data centers, and most importantly, electricity. The exponential growth in AI is creating a massive demand shock for the energy sector. Some analysts project that by 2030, data centers could consume over 11% of all power in the United States. This means the real bottleneck for AI's future might not be the supply of chips, but the capacity of our power grids. This creates a new potential risk for inflation, but also major investment opportunities in utilities and energy infrastructure. The move is already causing tension. When OpenAI signed its first cloud deal with Google, reports indicated it spurred Nvidia CEO Jensen Huang to initiate further talks with the AI startup. Google isn't just a customer anymore, it's a competitor with a serious home field advantage through its cloud services. And as we said, when AMD's big wins surfaced, once buyers have credible alternatives, pricing conversations change this time. The pressure stretches across both GPU and TPU ecosystems. What's really unfolding here is the rise of corporate compute sovereignty. Just as countries like the US and in the EU are passing laws like the CHIPS Act to bring semiconductor manufacturing onshore, these tech giants are internalizing their own chip supply chains. This strategy reduces their exposure to geopolitical risks, like tensions in the Taiwan Strait or US-China trade friction. Earlier, we noted how equity stakes and tight supplier partnerships let labs shape chip roadmaps. Today's update shows another route to sovereignty, anchoring on a cloud provider's proprietary silicon at unprecedented scale. For Chinese-speaking audiences, this trend is particularly noteworthy. US export controls have already caused Nvidia's market share for advanced AI accelerators in China to fall dramatically. This has forced Chinese companies to urgently develop their own chips or find non-Nvidia alternatives. Google's success in building a competitive in-house chip provides a powerful blueprint for how to achieve technological self-reliance in this critical field. As analysts at D.A. Davidson recently wrote, Google's custom chips remain the best alternative to Nvidia, with the gap between the two closing significantly. So, where does this all lead? Keep an eye on a few key developments. First, watch for more announcements from major AI companies diversifying their chip suppliers. Second, monitor the market share reports for AI hardware. If Nvidia's dominance begins to slip, it could trigger a major revaluation of the entire sector. And finally, look for any signs of pricing pressure on high-end GPUs. As competition heats up, the era of unlimited pricing power may be ending, and if TPUs keep scaling, that pressure could spill over across all architectures, not just within the GPU space. Disclaimer: all information is for informational purposes only and should not be considered investment advice. Market data is subject to change.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.